Now we're going to talk about option-like securities, callable bonds. Um, for the most part, callable bonds are part of the municipal bond market. Um, the treasury bonds are non-callable. They do not have a call feature. Most corporate bonds have a make whole call feature, so it basically that make whole call feature eliminates any benefit that you would receive. Um, Municipal bond issuers are able to refinance their bonds. The uh, those are only now after the new tax law, they can only be refinanced after the bonds are callable. They used to be able to be refinanced in advance. The idea of refinancing is just like if you were to refinance your mortgage and try to reduce your payment. That's the typical example of a municipal government when they would refinance. They would attempt to save money, lower the interest rates, and so forth. So callable bonds are simply the issuer pays a slightly higher coupon rate than they would on just straight non-callable debt. Um, and in exchange, they receive the right to call those bonds. Typically, it's after 10 years. And most municipal bonds, if there's usually little or no premium associated with that call. Um, so the investor's compensation is for the call option is the higher rate of return. As I mentioned, it usually includes a protection period of 10 years normally. So figure 1511 compares a straight debt or non-callable debt to the value of a callable bond. We see here as the value of the debt would go up. In this case, on the y-axis, it's not labeled, but think of we'd have interest rates falling, so your higher interest rates would be down here, and lower interest rates would be. So it's kind of an odd graph. But anyway, the value of the debt, straight debt is going to continue to go up until would go up until interest rates reach zero. However, there's going to be resistance on the part of investors to pay anything above the call price because they know that those bonds can be called away from them. So as a result, the value of that callable bond is going to be capped. So, convertible securities. The convertible securities convey an option to the holder. The most common type of convertible security is convertible bonds, and they give the holder the right to exchange that bond for common stock regardless of the market price. The figure 1512 shows the value of the straight debt and then the conversion value. So what we have here is as the stock price goes up, the value of that convertible bond will continue to go up, as opposed to in the case where it would flatten out. So there's option value here as well. So the option itself has value along with the value of the stock, the intrinsic value. So the buyer of a convertible bond is likely to pay a higher price. Option-like securities, warrants are option issued by a firm to purchase shares of the firm stock. A lot of times warrants are issued to key individuals in the company. They allow them to buy shares of stock, many times at a below market price. Collateralized loans, simply collateralized loans are a non-recourse loan beyond the right to the collateral. Leverage equity, anytime corporation borrows money, the maximum possible collateral for the loan is the firm's total assets. Exotic options. Asian options are options with payoff that depend on the average price of the underlying asset during a portion of the option life, as opposed to the price of the asset when the option is exercised. Currency translated options have either asset or exercise price denominated in a foreign currency. Digital option have fixed payoffs that depend on the underlying price of the asset.